Okay, so you're welcome once again. Um, Yesterday we had a look at the lease or buy decisions and we solved some questions on lease or buy. So today we want to complete the MPV session by looking at the last bit of it, which is the asset replacement decision. Asset replacement decision. So when a company buys an asset, it will also have to determine at what point in time would it replace the asset after uh, using the asset for its intended purpose. It would be going through some wear and tear, and therefore, at certain points, it will be prudent for the company to replace the asset. So it's also important that we look at asset replacement decision. All right. So the basic rule under asset replacement decision is that companies will usually prefer or prefer replacing an asset at a cycle that has the least cost replacements when it is considering replacing the asset. So, for example, there are two main methods which we will look at them, but the decision is that at any point it will consider various options and choose the one that has the least cost of replacement. So that is the decision when it comes to asset replacement. All right. Now let's look at relevant cash flows. So when it comes to asset replacement decision, we would have to go through the normal MPV computational process. And also, there are certain requirements that we need to consider when it comes to determining the cash flows to be used in the decision making process. So, in terms of the relevant cash flows for asset replacement decisions, we would be looking at the capital or purchase cost, which we looked at yesterday and subsequent lectures. Then we also look at the maintenance and operating cost. As you use the asset, you would incur a maintenance cost or service cost. As every now and then you have to subject the asset to servicing and maintenance, and that will come with a cost. And therefore, you have to consider this when it comes to the replacement decision. Then we also look at tax reliefs on the running costs. So the maintenance and operating costs may also attract some reliefs in terms of tax. So for example, if you use a machine to generate some inventory or revenue, there will be cost that is associated with running the machine in generating the revenue. That cost may be allowable for tax purposes. And in determining the replacement decision, you would have to determine the reliefs, tax reliefs on that running cost as part of the cash flows, if it is given in the exam that or examination question. And then also, you also need to consider the tax relief on the asset. So, like we have already considered, the tax relief on asset comes in the form of capital allowance. So you would have to consider determining the capital allowance under each of the methods. You remember, or if you recall, we said that there are two main methods in the determination of capital allowance. We have the reducing balance method and then also the straight line method. Straight line method gives us equal annual tax relief as well as capital allowance. Then the reducing balance is on a reducing basis. So if you determine your capital allowance, you have to take it from the cost and you get the written down value. The subsequent capital allowance will be based on the written down value. So you will not have the same capital allowance for the lifespan of the machine. So in each year, you have a different capital allowance. And that will also apply to your tax relief that you will get. Then we also consider the proceeds from the sale of scrap or residual value. So as part of the replacement, at the time that you would intend to replace the asset, there may be some residual value of the asset, which you may dispose of to realize some inflows. That cash flow must also be considered in the replacement decision. So these are the key considerations you have to make when it comes to determine the cash flow to be used in the asset replacement decision. All right. So now that we know the cash flows to be used in the asset replacement decision, the next thing we would have to consider is the methods of determining which replacement cycle is acceptable or optimizes the cost so that we can apply that replacement cycle. There are two key methods that we consider. We have the equivalent annual cost method and then also the lowest common multiple method. So these are the two methods that we use when it comes to asset replacement decision. Now, the equivalent annual cost method usually deals with determining the PVs of the cash flows and then also determining the annuity factor for that cycle and dividing the PVs over the annuity for that cycle. So usually we have the formula as equivalent annual cost in n years or n cycle is equal to the present value of cost of one replacement cycle of length n and also over annuity factor of 1 to n. So equivalent annual cost method. This is the formula that we consider. We shall apply the question so that you know how it works. Then when it comes to the decision, I've already stated that the preferred replacement cycle is usually the lowest of cost of among the cycles. So if I am considering 1 year cycle, 2 year cycle, and 3 year cycle, I would have to determine the PV of cost of all the replacement cycles and determine their annuity factor and divide by each of them by the annuity factor and arrive at a certain equivalent annual cost. I will compare the equivalent annual cost of all the cycles and determine which one is the lowest, and that will be the optimum cost which will be adopted for asset replacement. Now, the major weakness that's associated with the equivalent annual cost method is that it fails to take into account the effect of inflation. So majorly that is the weakness about it. Then the complexity around it is how to determine the annuity factor and then the PVs of the cost of a replacement, one replacement cycle to the other. So majorly this is the issue about the equivalent annual cost. Now when we look at the other method, which is the lowest common multiple method, you remember when we were in the lower primary, we were taught of LCM. So we are given a certain set of numbers and we are asked to determine what is the lowest common multiple of those set of numbers. It's the same principle that we are adopting for this method. So we choose the lowest of the different possible cycles over a common time frame. So for example, if you are given a consideration for 1 year, 2 year, and 3 year replacement cycle, you would have to determine the lowest common multiple of the cycles above. So 1, 2, and 3. We know that the lowest common multiple will be 6 years. So if you multiply 2 by 3, you get 6. And if you multiply 3 by 2, you get 6. And then if you multiply 1 by 6, you still will get 6. So the lowest common multiple will be 6 years. So that's how we will determine the lowest common multiple. And then we apply the cash flows to the replacement cycles. We shall look at it when we get to the computational aspect. Again, if you are looking at the decision, the preferred replacement cycle with the lowest common multiple method is the least cost replacement cycle, just like we have already considered before. The issue with this method is that it is very simple and also consider the effect of inflation, except that in determining the cash flow, you need to pay particular attention. Otherwise, if you make some mistake, then it will affect the overall conclusion that you draw. So these are the two methods that we look at when we are looking at the asset replacement cycle. All right. So let's quickly consider this question, and then we would see what we can do after this. Corona Exams Limited is considering its replacement policy for a particular machine, which it intends to replace every year, every 2 years, or every 3 years. So these are the cycles. So we have 1 year, 2 years, and 3 years. The purchase cost of the machine is 17 million Ghana cedis, and its maximum useful life is 3 years. And then we have also been given other relevant information relating to the question. I think there is something here. Other relevant information relating to the question. Okay, so we can. All right, so this is the question that we are looking at. Now, other relevant information about the machine is as follows. So we have the maintenance or running cost of the machine. So year 1 is 1.8 million, year 2 is 2.5 million, and year 3 is 3,750,000, 3,750,000. Then the scrap values sales at each year end is, for year 1 it will be 7.8 million, year 2 will be 5.2 million, and year 3 will be 4.5 million. Required. If the company's cost of capital is 10%, what is the optimum replacement cycle under A, the Icag method, that's the equivalent annual cost method, and then 2, the lowest common multiple method, and you are asked to ignore taxation. All right. So this is a typical asset replacement question. And this one, when it comes, you see that students are all over the place. All right. You remember the last time you saw a question like this? Do you remember the last time you saw a question like this one?
A question like
The asset replacement cycle question. Okay, so I already have the facts here. So these are the facts of the question. So let's look at it. So the purchase cost. So we are looking at Corona Exams. Corona Exams Limited. Name of the company. And we are looking at assets replacement cycle. Asset replacement cycle projects. So asset replacement cycle projects. No. All right. We have been told that the purchase price of the machine, equals 17 million Ghana cedis. So 17 million Ghana cedis. All right. So now we're looking at the fact of the question. So we are looking at the fact of the question. So we have 17 million Ghana cedis. So these are the facts. Then we are given the other relevant cash flows. So maintenance and running costs, these are them. And the scrap sales are also there. All right. So they are also there. Then we are told that the cost of capital, the company's cost of capital is about 10%. The cost of capital is about 10%. All right. So we are to determine the most acceptable cycle of replacing the asset, given the following information and also the cost of capital of 10%. Now the lifespan of the machine is equal to 3 years. All right. So these are the facts about the question. So all the information we need to solve the question, we have it here. So we can now proceed to look at the question from this angle. All right. So now let's consider the following. So the first question says we should consider I, looking at the question from the perspective of the equivalent annual cost method approach. Equivalent annual cost method. So equivalent annual cost method. All right. And we said that under the equivalent annual cost method approach, you determine the respective cycle. So we know that the company has 3 cycles it is considering. It's considering 1 year cycle, 2 year cycle, and also 3 year cycle. And we said that for the equivalent annual cost method, you would have to determine the PVs of the cash flows and divide it by their annuity factor to arrive at the equivalent annual cost method. Are we fine?
Yes, sir.
All right. So now let's proceed to dealing with the questions as we go along. All right. So now we have the 1 year cycle. So we have one year cycle. So 1 year cycle, we have the years, we have the details, then we have the PVs. So years, details, PVs, and then when we have done that one, we have the year or time. So we have year, we'll have the details, then we have the cash flows. We have the detail cash flows. Then we now have the discount factor at 10%. Then we now will have the PV. All right, so we now have the PV. So let's say here is the details. All right. So this is the 1 year cycle we are considering. All right. So we have 1 year, isn't it? So 1 year we have year zero, which is for the cost. That's the purchase cost. Then we also will have the 1 year for maintenance and running cost of the machine. Then we also have 1 year for 1 year for the scrap value of the machine. So details, we have the purchase price or purchase cost, and the cash flow for how much is the machine going for? Hello, how much is the machine going for?
Purchase price is 17 million.
The purchase price is 17 million. Yes. Yes, there was a class. I sent you a message. All right, so check it. All right, so the purchase price is 17 million. That's year zero. Then year one, we have the maintenance or running cost. So we have maintenance slash running cost. So maintenance slash running cost. Running cost for year one is what? What's the running cost for year one?
18 million.
The running cost for year one is how many years? Running cost for year one is how many?
1.8 million.
So 1.8, isn't it?
Yes, so 1,008.
So 1.8. So we have 1.8. Then we also have the scrap sale value. Note that these are costs, so they should be negative. This one too is also cost, so it should be negative. Then you have the residual value. So residual value, the sale will give us a positive figure of 7.8 million, which is that. So we now have to get the discount factor, and discount factor for year zero at 10%. This one is equals to 1 divided by 1.1 to the power of 0, and that gives you 1. And you do same for that, and that gives you this. So when we get that, we now will multiply the discount factors by so let's reduce this one to 4 decimal places. So we have it into 4 decimal places. All right. So we multiply this by that, and we get that. So that by that, we multiply them, and we are getting 4 decimal places. All right. So when we finish, we now sum them up. So we sum the cost up. So this cost is equal to sum of the constant values of the cost, and that gives us 11. So we know that equivalent annual cost is equals to the PV of the cash flows. So PV of cost of machine over the annuity factor. So over annuity factor for year 1. In this case, N is equals to 1 year. All right. So this is how we arrive at this. Now, how do we determine the annuity factor? What is the formula for annuity? Present value of annuity. Hello? What's the present value of annuity?
So that one is 1 minus into brackets 1 plus I brackets close 1 plus I brackets close, and then raised to the power negative n all over I.
Also to the power negative n
all over I.
So you divide all of them by I. Okay. So if you have this one, all we do is that we insert the formula into it. So we have 1 minus 1.1, because this is annuity. We will still get 0.91 something because it's to the power 1. So this one to the power negative 1. So you divide it by 0.1. So you get the same as this figure here. So if you raise it to, so you get 4 decimal places. So this is the annuity factor. So it means that the IAC for year 1 is equals to the present value, which is this one, and divided by that. So if I divide this by that, what I'll get is, so this one is equals to negative 114,545.45 divided by 0.9091, and that will give you a cost of 12,000. So this is the equivalent annual cost for year 1. So this is it. So for year 1 cycle, this is how we will arrive at the equivalent annual cost for year 1. I hope this is clear.
Yes, sir.
All right. So now that we have gotten the year 1 cycle, we now move to year 2 cycle. So this is year, and we are looking at year 2 cycle. So year 2 cycle, we are going through the same thing that we did here. So we have all this here. And so here we will have, for year 2 cycle, we will have year 1 and year 2. Do you understand?
Yes.
Hello?
Hey.
For year 2 cycle, what I'm saying is that you see, if it is 2 years, what that means is that you incur the cost of year 1. Is that fine?
Yes, sir.
Because you incur the cost of year 1 before you incur the cost of year 2. So what that means is that you have 0, and then you have 1, and then you have 2 and 2. So the 0 will be the purchase cost, which is that. So we have the purchase cost that. We have the maintenance cost, which will be 2. Maintenance for 1 for year 1, and then the other one for year 2. Then you have the residual value for year 2. So what that will mean is that we are going to have the purchase cost of 17 million. We are going to have the maintenance cost of 1.8 for year 1, and then you have the maintenance cost, running cost for year 2, which is negative 2,500. So that will be there. Then the scrap value will no longer be 7.8. It will be 5.2 because we are looking at year 2. So that will be 5,200. Now we determine our discount factor. So discount factor for year 0 will be the same. That for year 1 will be the same. But we have to determine for year 2, in which case we are going to have that, which is this. So it's the same thing for that. So year 2 we are having this. When you are done, you now multiply the discount factors by their present value. So if you multiply them, you are going to get this. All right. So we now sum all of them up. We sum them up. So if you sum them up, this is what we are going to get. So we have the present values. The PVs will be, so PV, the total PV will be what? So here should be total PV. It's the same as this. When you are done, you will now determine the annuity factor for year 2. So we have to determine the annuity factor for year 2. Okay. So annuity factor for year 2 means that we would raise this one to the power 2. To the power 2. And that gives us 1.73 something. So the equivalent annual cost. So equivalent annual cost for year 2. So 2-year cycle. So 2-year cycle will be equal to the negative 16.404.96 divided by the annuity factor of that. So we are dividing that by that. And when we do that, we get this. So this one is equal to this divided by that. And you are getting equivalent annual cost of 9,400 and something as equivalent annual cost. Okay, so we have this one. Then we move to the 3-year cycle. So we are done with this. So we move to the 3-year cycle. So here, this is 3, and the same information that we use up there will be used here. Remember that because we are considering 3-year cycle, what that means is that we're going to have year 0, year 1, year 2, year 3, and 3. That's what is going to, what we are going to, what is going to happen. Are we fine?
Yes, sir.
Because what that means is that you're going to incur the various expenditure across the 3 years. The purchase price will be the same. The residual value for year 3 will also be the same. So what we are going to have is you are going to have year 0, 1, 2, 3, and 3. That's residual value for year 3. Okay. Then the details, we are going to have the same, which is that, and then you have it for that, which will also be the same as year 3. Then the last bit will be the residual value for year 3. So you put the cash flows there, which is the same as these. So which is the same as this. But that for the year 3 is this. That's 3750. 3750. That for year 3 is 3750. 3750. Okay. So you have 3750 for that. And then the residual value for year 3 is 4.5 million. So that is positive 4.5 million. All right. So the discount factor will still be the same. So for year 1 and 2 will be the same. By year 3 will be this. So I then multiply them by their discount factors. So that should give me that. That should give me that. All right. So this is it. When I finish, I sum all of them up. And that will give me that. Then determine the annuity factor for year 3. So annuity factor for year 3. Here we'll change to year 3. Annuity factor here will change to 3. And so that gives me 2.4 something. So I get my annuity factor. Therefore, my equivalent annual cost will be that. Okay. So this one is equals to this. Then this one is equals to that. All right. So when I divide this by that, I'll get 8.83. So when I look at the summary, when I am done, I look at the summary. So summary. So the summary I'm looking at of the Icag method. All right. So I have this there. So I have 3 of them. So 1, 2, and 3. So I have year 1, then I have 3 years cycle. So here the cost. So cost. Cost. Here gives me the first one, which is that. Then this one gives me the second one, which is this. And then this one gives me the third one, which is that. So after I've done that, I now come to my decision. So asset replacement decision. So what is the decision? Yes, what is the decision? So the company's asset replacement cycle, the company's asset replacement cycle should be 3 years. Should be 3 years as it offers lowest EAC cost of 8098.19 million. All right. So on the whole, when we are going through the annual equivalent cost method, these are the decisions that we go through, and this is how we arrive at the annual equivalent cost method. Is there any question that I should take?
No, sir.
All right. So this is how we go about determining the annual equivalent cost method.